Good morning. Today is Wednesday, June 12th. I'm Joe Terril, president of Terril and Company, independent wealth managers headquartered in St. Louis, Missouri. With me today are senior portfolio managers and analysts Dave Carter and Russ Phillips. This is another update on our thoughts on the economy and markets, and let's get right to it. The economy continues to be okay. People are spending money, and the consumer is carrying this economy. We believe that's going to continue. There are concerns from some that the economy is getting ready to fail because the consumer spent out, the consumer has too much credit card debt. We see it differently. The consumer is making money. Pay increases have been averaging better than 5%. Average hours worked are up. Overtime is up. We see it that the consumer is in decent shape, and the economy will continue to be strong. This leads into what is going on with investment markets. The Federal Reserve Bank would tell you that they are tight on credit at 5.5% interest rates. We believe that comment is close to nonsense. They're not tight. You can have all the money you want. You just have to pay 5.5% for it. And we see that speculation and people borrowing money and speculating on, if it's not cryptocurrencies, it's meme stocks with the recent movement you've seen in GameStop. It's the technology stocks. It's anybody that has anything to do with AI, whether it's all hype or whether there might actually be some reality there that one day they're going to sell a product based on AI and actually make money off of it. So it does concern us in investment markets that you see as much speculation as I can remember that's going on in the markets. So we will see investments have been very, very narrow, concentrated in high-tech, speculative growth stocks. One stock has made up 33% of the entire move of the S&P 500 for this year. That's not a healthy market. We continue to invest, not trade, not speculate, but invest our clients' money in issues that we believe offer a lot of merit, that are down in price. After all, you want to buy at a low price, not a high price, and we're making good dividends. We're making, good income off our fixed income portfolio, and we're pleased. But most important of all, we feel it's really necessary to stay away from this speculation. It's fine when the speculators are making money like they have in the last 30, 45 days, but you never know when the bottom will fall out and you'll be down 30%, as happens. So we continue to find good value in issues. But let's first maybe talk about interest rates. Dave, why don't we chat for a few minutes about what have been the returns in fixed income for people who have not stayed short like us? Have they made any money?
Over the last 2 years, if you have been invested in the fixed income index, the ag index as we call it, over the last 2 years, you're down almost 6% annually. And
So that's to say that the aggregate bond index, you've lost 6% if you've been an investor of that for
Correct.
the last 2 years?
And that's a broad index. It includes treasuries, corporates, mortgage-backed bonds, some other asset-backed bonds, and it's a very broad index of corporate of bonds with a duration of about 7 years. And so that tells you, when interest rates rise, what happens to the value of the underlying bonds. And the coupons really didn't support the value of the portfolio. So you weren't generating the cash to give you a positive return.
Our position is that's going to continue. We've avoided that. We've made nice returns for the last couple of years, basically just rolling over short-term issues, making 5% plus. We think that's going to continue to be the place to be. But let's switch maybe to stocks. Russ, you're almost a 25-year veteran in this area. Chat for just a few minutes about what's going on with stocks in general, to put it maybe in perspective.
I think David characterized it exactly how it should be. Over the last 2.5 years, if you've been a client invested in, specifically a retired client, invested in a 50-50 portfolio, to David's point, you've had negative returns. On the equity side, with the exception of technology and a few narrow technology stocks, we've seen Apple here recently start to do better with their announcements in AI. Anything AI related has exploded to the upside and created some of this fervor, euphoria that you were talking about. But if you take a step back and look underneath the hood, the equal weighted S&P returns on the equity side are actually flat. So if you've been a client that's been invested, diversified in a 50% equity portfolio, 50% fixed income portfolio, there's a strong possibility that you've not made any money over the last 30 months or 2.5 years. On top of that, if you've taken distributions, you've probably seen your account go down.
We have seen financial stocks and basic industry stocks go lower in the last 3 months. I know we think, but maybe just address for a few minutes, why is there value in these stocks even though they're not participating in this speculation?
I think there's value really in my mind for two specific reasons. One of the things, one of the thesis we have for clients is, as you mentioned earlier, we like income. We like dividends for our clients. That tends to offset some of the volatility of the stock market. That shows up a lot in some of the financial stocks and some of the basic industrials and metal stocks. The other thesis, and you mentioned this earlier, we like to buy low and sell high. The material stocks represent opportunities. Gold stocks, specifically, we own a few of those in our portfolio for clients. When you look at the valuations of gold stocks, they're in that value camp which we support.
We will be back with another update. Brian Curtis, our producer here of our videos, thank you for your help, and we'll be back in perhaps 3 weeks. We'll see June 30th is the end of the first half of the year, and we'll update what returns are, and we'll be back. Thank you for tuning in today.